At Earnings Whispers, we're first and foremost an earnings research firm, but we consider ourselves analysts of analysts. We track analyst performance, we follow analyst data checks and models, we read analyst reports and commentary, and we interview analysts. Basically, we aren't out there kicking the tires, but we follow as closely as possible those that do kick the tires. The result? Well, after more than 85,000 published Earnings Whisper numbers from approximately 11,500 professional buy and sell side analysts, is an expectation that has been more reliable than the consensus earnings estimate more than 70% of the time. Earnings Whispers is a surveyor of investor sentiment, with the largest database of investor sentiment around earnings releases, with roughly 1.7 million expectations for earnings and price reaction from more than 280,000 individual investors. At the same time, we monitor other sentiment indicators such as short interest and option activity. At Earnings Whispers, we are also data scientists. We've studied approximately 350,000 earnings releases and more than 90,000 guidance announcements. We've added millions of additional data points and ran thousands of studies on the data. What we've done is quantitatively back into Richard Bernstein's earnings expectation life cycle. We often say stocks move higher ahead of positive earnings, gap higher on positive earnings, drift higher following positive earnings, or a combination of the three, but seldom all three. Of course, the opposite is true of negative earnings releases. What we know to be fundamentally and statistically true is you want to buy stocks after they report earnings when they're in the positive earnings surprise phase of the life cycle, both in the short term and the long term. You want to be long stocks ahead of earnings releases in the earnings momentum phase. You want to sell or short stocks in the negative earnings phase. And you want to sell stocks ahead of earnings once they become value traps. At Earnings Whispers, we're also chartists and technicians. Because it isn't always enough to have statistical odds on your side. You need to know where a trade is going based on the chart pattern, where it's likely to pause based on support and resistance areas, and more importantly, we need to know where we are proven to be wrong. These four disciplines are combined with our Earnings Whisper plays. Short-term trades either before earnings or after a company reports based on the true earnings expectations, the investor sentiment, quantitative studies, and technical analysis. Since we launched our service in 2002, a conservative approach to our trading strategy produced a 680% return by buying at the open on the first trading day and selling at the close on the second trading day, without compounding returns and without using margin. So, the secret is that the money talks following Earnings Whispers.